Okay, folks, welcome to Best Stock Charts for the coming week. This is Bob Desmond, and we're going to kick things off with the calls that we've made on the market over the past several weeks. Back on January the 16th, I posted on StockTwits that I believe that we were in a bubble in this market. I gave my rationale from Bitcoin to the US dollar to gold to the NASDAQ composite. And then as we continue to elevate to ever loftier levels on the market, on the 28th of January, I posted that traders were whistling past the graveyard. These posts, these videos are still on StockTwits, Twitter, YouTube. I post them on third-party sites to validate the calls that we are making here at the Contrarian Trader. The memorialization of these calls allows us to gain the trust of our viewers to ensure that the technical analysis that we're doing here is for real. And here's what I had to say about the 30-year bond, the proximate cause of this sell-off. Have no doubt about it. Here's what I had to say about it on my post from the 28th, Are Traders Whistling Past the Graveyard? It's because every single bubble over the past 30 years has been pricked by a rise in interest rates. And the chart that you're looking at right now is the 30-year bond price, not the yield, but the price. Now, if we have prices breaking down, what does that mean for yield? Obviously, they're going in the opposite direction. What is the probability of us making lower lows in February? Quite high. Now, why does this matter? As I just said, you have seen bubbles pricked because of rising interest rates, and of late, over the past 15, 20 years, big stock market rallies have been pricked by interest rates that rise to lower prices, meaning they don't need to rally as much anymore to prick the bubbles. So that was from January the 28th. Fast forward to today, the 3rd of February, and look at this chart now, the very same chart, the 30-year bond price, and we are cratering. The month of February, we have a new monthly low. We're heading down here to retest this lower band of support, and it's in all probability we're going to see that lower band of support next week. So expect more volatility in this market. Now, before we go through the rest of these charts, I'm going to list the symbols in the sequence in which I'm going to review them right above on the website. And if you're watching this on YouTube, just check the video description box below and you'll find those symbols in sequence. And members, we're going to go into great detail on where we believe the markets are heading this coming week on the week ahead commentary coming out on Sunday. And it's on that video where we formulate our strategy as we proceed into the coming week. Now, you may be saying, how did you proceed into last week with your last commentary? We went into last week short of the S&P 500 using the SPXS. This is a leveraged ETF putting you short of the S&P 500. Now, I wish I could say we stayed for the entire ride down on the S&P 500's decline last week. We did not. But still, unlike most traders who were asleep at the switch, ignoring every single market signal that was out there, whether it be the VIX, which was creeping up along with the stock market, or the fact that on a weekly basis we had RSI above 90. Never heard of. It's never happened before, yet traders were willing. And I'm not just talking about mom and pop buying 100 shares. I'm talking about institutions. How do we know there were institutions buying the S&P 500 with RSI above 90? Think about the fees these guys get paid. We knew it because of volume. Look at these volume bars. Big volume bars buying the S&P 500 with RSI at extreme overbought levels. And last week, those very same fund managers got clubbed like baby seals. So with all of their fancy educations, their ability to appear on CNBC and deliver their sales pitches for a booming stock market and economy, they have an inability to use their overpriced educations to identify a market top. So as we proceed into the coming weeks, I believe that we will probably be short the market once again. Is this a top? Are we going into a full-fledged bear market? Unlike the banksters that appear on CNBC, I'm not going to give you a sales pitch and try to lure you into believing that the markets are only going to go straight up, that this is the pause that refreshes. I will give you my straightforward answer, and the answer is I don't know. The charts will tell us in which directions the market is going to go. As it stands right now, the path of least resistance, despite the sell-off last week, is still up. But I will be monitoring and communicating with our members on a daily basis where we believe that this market is heading. And for those of you that are relying upon the financial news media for guidance, how did that work for you last week? So join us here at the Contrarian Trader. The 14-day free trial offer is going away next week. So what we're watching into the next coming week is SPXS. Again, we booked profits here. We'll be looking to get back in. Volume was outstanding last week. Members, we're going to drill down to an intraday chart on the S&P 500 and the SPXS to identify where we would want to enter a long position, and we'll discuss strategy this weekend coming out tomorrow on the week ahead commentary. The triple Qs. I am bearish on the triple Qs. I think they're going lower. I think they're overpriced. In fact, the entire market is overpriced. It's just not me saying this. Just simply take a look at earnings this quarter. And here you have it, quarterly chart, the S&P earnings. Now, earnings season isn't over yet, but a lot of those who would have reported have reported. So at current, we are lower than the prior quarter. Not good when you have a market which is trading on the S&P 500 price to sales at a high not seen since the dot-com crash. And this chart here should make you extremely nervous, because if in fact we do continue lower, we have a record amount of margin debt. What does that mean? It means that margin calls are going out because the average investor and hedge fund is over leveraged. They have no cash, therefore they will sell what they can sell. So even your best stock with great multiples, great fundamentals, they're going to go down too. So while we may look at this and say, okay, we have a correction on our hand, folks, you had better be building a shopping list. Because what we were doing last week was building cash, booking profits for the past couple of weeks in our longs, raising our stops, and building cash. Why? It's because there are going to be some great values out there, and we're going to want to take advantage of them. So members, we'll be talking about those values in the coming week and weeks. So pay attention to this, folks, because if we continue lower to resolve this problem here with record margin debt, anything that can get sold will be sold. The selling will be indiscriminate. Now, what are we looking to buy to get short of the QQQs? The SQQQ. Weekly chart, RSI is rising, SOXS are rising. Nice week last week, an outside week, and a breakout above the secondary downtrend line, which I don't have drawn. I'm just visualizing it. Let's update the chart. I'll be right back. All right, so here you have it. I believe that last week's breakout was simply a reaction to an overbought market and an oversold SQQQ. While there is some upside potential here, we do have significant resistance above. So don't get me wrong, while I believe that there's a bear case to be made in this market, I do not believe that we are going straight down absent a geopolitical event. So members, more to come on the SQQQ. Amazon, my favorite short. They reported earnings, they moved higher, but they closed well off the highs of the day. I think that Amazon is poised to move substantially lower. Note the lower highs on Ultimate Oscillator. Note the topping action on the 31st, the bearish key reversal on the 1st. You had earnings that salvaged, but we closed well off the highs of the session. That's a hollow-filled candlestick, and it's one of the few candlesticks that you do not want to see at the top of a trading range. The other one is a topping tail. The other one is a bearish key reversal. So we had three consecutive candlesticks, which are basically signals by the market saying, get out. So members, more to come here with strategy on shorting Amazon. What else are we bearish on? The semis. We shorted the semis a couple of weeks ago. We booked our profits, and they subsequently broke out. So thank goodness that we got out. Now we have rolled back over again, and we have a bull trap on the SMH, or a breakout point failure. I think that the semis are going to get clubbed really hard, even if the market bounces back. Why? It's because they lost their leadership position. They were leaders. They are now laggards relative to the S&P 500. Volume last week, very high. So members, more to come on the SMH. And we'll probably use what we used before to short the semis, and that is the SOXS. We bought here on the 23rd. We sold up here. We got our pullback, a higher low, and now we're moving higher once again. We cleared a pivot point at 1334. The chart looks really good. What else are we watching for? Gold. Now, for the sake of transparency, before I get into this chart, I want to talk about NUGT, of which I own, but we stopped out of half of our position last week. Why? We closed below weekly support. I think we're going lower in the coming week. We'll probably retest the $28 per share level. We'll see if that holds or not. Back to gold. And we will be looking to build on our NUGT position, assuming that support levels hold. Now, gold, believe it or not, last week did not put in a new weekly low. And in fact, we are up on the quarter, but we do have resistance immediately above. Now, I mentioned on Morning Update to members that I had my concerns about the gold mining trade and the US dollar. And here's what I had to say. Positive. NUGT, same deal here on a daily chart. I'm not impressed by the price action. I mentioned it here on the 31st that I was not impressed by this reversal day. We could not close positive. We could not close above resistance. And I'm concerned about a rally in the dollar. My concerns will be abated if we break down below the daily lows last seen on the US dollar. The dollar, we're very close to a breakdown here on a daily chart. A lot of resistance above. Volume is still high on a daily basis. ADX, though, it looks as though we may get a pop here soon. And MACD, the same deal. I said that yesterday as well, which is not good for our NUGT trade. Let's go to an intraday chart. We'll use the 1 hour chart. Still relative weakness here. Ultimate oscillator is no longer putting in lower lows. We are putting in lower lows on Stokes, RSI making lower lows. If they sell it off here, I would expect a quick short covering rally on the dollar. Then we'll have to take it from there to see where the dollar is going to go. Because the dollar, the problem with this trade, with the NUGT trade, is that while the dollar moves higher, it's almost guaranteed that NUGT, the gold mining names, move lower. And while the dollar trades sideways or down, 3/4 of the time, the price of gold and the gold mining names move up. So it's not a really equal inverse correlation. So that's why I'm a bit nervous here about a rebound in the dollar. All right, so from my commentary from Friday morning, the morning update before the market had opened, you could see that I was a bit nervous about a rally in the US dollar, and that if there was a rally in the US dollar, that it would adversely impact the NUGT trade. Now, why is it that with the market selling off and gold being a safe haven play, that gold and the gold miners sold off yesterday? Well, you have the dollar, which in fact rallied, but fear sometimes allows the two to trade in tandem. You saw that during Brexit, where gold and the miners traded in tandem for a brief period of time. So it's not unheard of. It's rare, but it's unheard of. The problem is as I mentioned earlier, with the sell-off in the markets and the massive amount of margin debt out there, is that as margin calls get sent out, traders will sell whatever they can sell to meet that margin call. So a sell-off is going to be broad-based. But out of the ashes rises the phoenix. And I do believe that gold and the miners will be leaders in the coming months. Why is that? It's because the dollar has to crash. The reason why the stock market is taking it on the chin right now is because you have yields that are rising. And the market's telling you, we can't take this anymore. And yields aren't even normalized yet, and you have the stock market, which is rolling over in panic. So why is the dollar going to tank? Let's go to a chart of the dollar. It's because we have twin deficits. We have an ever-expanding budget deficit, which is soon to be increased because of the infrastructure bill of $1.5 trillion, and a trade deficit. So what foreign investors in our bonds are saying, hey, listen, there's a lot of risk in your market. We need to get paid higher interest rates on your bonds, meaning U.S. Treasuries. How is the Federal Reserve going to manage rising interest rates? Because remember, to the American public and to the politicians in Washington, the economy is not the economy. The stock market is the economy. It's the benchmark. It's the measure. Donald Trump now owns this stock market because he's embraced it. He bashed it during the election, saying it was overvalued. He was right then. It's become far more overvalued over the past year, and he has embraced it as being a market that is reflecting strong economic growth. But the economic growth data that's been released so far doesn't reflect that. Now, don't get me wrong. I voted for him. I want him to succeed. But the only way to keep this market from crashing is to get yields under control. Because if we hit a 3 handle on the 10-year yield, look out below for this market, and we could be there next week. So what must they do? The Federal Reserve needs to guide down expectations of future rate hikes. At current, they're talking 3. The media is talking 4. They need to ratchet that back real fast. And you can see that the dollar, as we wrap up here, it didn't even close at the highs of the day on Friday. It couldn't hold its mud. It closed well off the highs of the day. It met resistance. Does that mean the dollar can't rally further? Sure it can. It's oversold. But I think that rally in the dollar is going to be short-lived, and we are rolling over, and we are going a lot lower on the U.S. dollar. How do I know that? Is it simply the charts? Let's go to a weekly chart. Is it simply the chart? Well, the weekly chart certainly doesn't help, right? The technicals are dead awful. Now, we did rally off the lows for 2 consecutive weeks. It implies that we may see a continuation move higher here. But the trend, folks, as I've been saying for over a year now, is down. Lower highs and lower lows, and in between, you get a counter trend rally. Now, you have the 50-period moving average, which is going to take out the 200-period moving average within the next 2 weeks. Absent an act of God, that's going to happen. That will act as a weight, a technical breakdown on the U.S. dollar. Add to that, just simply take a look at your Stokes. We're having a dead cat bounce here. We can continue higher, but I think we're rolling back over again on the Stokes, and that's when the real damage is going to occur here. What else are we watching into the next trading week? U.S. Steel. We booked profits on U.S. Steel right here. Why? We met resistance, and we didn't want to hope when we should fear, meaning we didn't want to hope for a breakout above resistance. We wanted to book profits and watch. Even if it meant paying up a few dimes to buy back in above a resistance level, so be it. The payback for our discipline, we avoided this train wreck, which was a correction of over 15.5% on the week last week. And my guess is that we are moving lower. So we're looking for a retest of this lower band of the rising uptrend channel. We will look to buy back in at those levels. Members, more to come on U.S. Steel. And that's it, folks. Members, stay tuned for the week ahead commentary coming out tomorrow. If you're not currently a member, the 14-day free trial offer is going away this coming week, so jump on it quick. And everybody have a profitable trading week next week. Be well.